Aerospace and defense ETF soaring? For a bold trade in this sector, trade DFEN, Direxion's Daily Aerospace and Defense Bull 3X shares. Don't miss your next big trade. Direxion Leveraged ETFs.
An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direxion shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit us at www.direxioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors, such as traders and active investors. Distributor, Foresight Fund Services, LLC.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
Okay, coming up on today's program, does your retirement portfolio have an adequate cushion? Also coming up on the show, we're going to give you a recap of what's going on in global financial markets, including a sector check, tell you what's happening there in key industry sectors. If you'd like to join us to talk about anything on your mind financial, that could be an individual stock, it could be an ETF, mutual fund, financial question, investment-related question, 844-305-7800 is the number. Do give us your first name along with your city. You can also tweet the program live at Index Show. Again, at Index Show is where you find us on Twitter. We'll get you caught up on what's happening there on the Twitter feed. A lot of good stuff. So taking a look at stock market action from this past week, it is October, and it should not surprise anybody that the stock market is currently in the midst of a correction. Now, we take a look at the total U.S. stock market since the start of the year. It is still in positive territory. Ticker symbol SCHB, that's the Schwab Total U.S. Stock Market ETF, up ahead by just over 4.25%. So, good so far for 2018, but nevertheless, we've given it back about 7% just through the first 2 weeks of October. So, what that tells us is that market prices can move very quickly, and usually on the downside, they move a lot quicker than to the upside. Now, in terms of other markets from around the world, we take a look at international developed market stocks, which have also been not performing well, actually much worse compared to the U.S. VEA down almost 8% on the year. VWO, which tracks emerging market stocks from places like China and Brazil and Russia and India, VWO down about 15.3%. So emerging markets have been the worst performer in terms of equity performance. Now, in terms of other key asset classes, global real estate is down just over 2%, REET, and total U.S. bond market down about 2.5%, BND. And then finally, commodities as a group, USCI down 1.5%. So that's your big picture view in terms of asset class performance. U.S. stocks still, on a year-to-date basis, an outperformer. Nevertheless, we have seen weakening performance, and it is quite worrisome from many perspectives. First of all, from the perspective of that, you take a look, and this actually is in the November issue of ETF Guide Premium, which has just been released, and I want to share some tidbits with you on that a little bit later. But on page 12 of ETF Guide Premium, the November issue, we've got a nice global equity map which shows the performance of the various regions from around the globe and how they're doing in terms of performance so far in 2018. And of course, with ETFs, it's very easy to track this because ETFs track a variety of countries and regions and so forth. So if we just take a look, though, at the global equity map in terms of stock performance globally, there's only one place in the entire world that is now posting a positive year-to-date gain. That means from the start of the year, January 1st, up until now, market close October 19th, that is the total U.S. stock market, which is ahead, like I said, by over 4.25%. The rest of the globe is red, and certainly that is not good in terms of performance globally. You want to see broad participation with stock performance. And so the question then becomes, will the U.S. lift up the rest of the world, or will it be dragged down by the negative performance elsewhere? That's something that I'm currently monitoring, and it's something that investors from around the globe, everywhere, especially retirees and pre-retirees, should be thinking about as you try to protect what you've accumulated in retirement. So we're going to talk about this topic on today's program. Does your current portfolio, have an adequate cushion? And we're going to give you some tips on how to shore up your investment portfolio ahead for perhaps rougher waters. 844-305-7800 is the number. We're here. If you'd like to join us, at Index Show is my Twitter handle. If you'd like to pose any questions or comments. Want to also remind our listeners that if you, for whatever reason, can't catch our regular show on the radio, you can pick up our podcast. It's available at iTunes. You can also find us as well at Google Play. We have a YouTube channel and SoundCloud. And again, look for us. Just search under the Index Investing Show. You will find us. We archive every single broadcast. Also, as I just mentioned, ETF Guide Premium, which I write and contribute to and put together along with several other analysts, is available and is out. Go to etfguide.com. The November issue has just been released. And as I just indicated to you, we've got the global equity map, which gives us a real quick visual on what's happening with ETF performance around the globe. Also, the November ETF income trade. This is something that we do every single month in ETF Guide Premium. We generate income by selling covered calls on a hypothetical all ETF portfolio. It began in February of 2012 with $100,000. It's a unhedged ETF portfolio, and we just sold some covered calls for our November ETF income trade, generated $410 of monthly income. Great way to add this to your arsenal, those of you looking to generate more income over and beyond dividends and income that you get from bonds. So check that out. I guess the quote from the day or quote for the week would be this: the stock market doesn't beat anyone, people beat themselves. Isn't that true? We beat ourselves. And when you think about it, stock prices are not a reflection of valuations, but rather our psychological manias or psychosis. That's what stock prices are a reflection of. This idea that stock prices reflect valuations is absolutely untrue. Maybe there are analysts out there that believe that, but it really is not true at all. It's really stock prices, as the great Gerald Loeb once said, are shaped by public psychology and how investors feel at any given moment, mood-wise. And right now, the mood has turned from very, very happy and jubilant to on the verge of manic depression. And it hasn't even really been a very severe correction at all. So this market is what we might call squirrely right now. It's not a bull market. Well, it is. It has been a bull market, but the bull is slowing. It's not a bear market, that's for sure. So it's kind of in between right now at this point. It's in transition. It's what we call a squirrely market. And as I said before, if we look at this since the beginning of the year, we're still ahead by over 4%. Also, corporate earnings, S&P 500 companies have been reporting earnings for the third quarter. And according to FactSet, we've got almost 20% of companies within the S&P 500. They've already reported actual results for third quarter earnings. And guess what? Earnings have been good. And that's a positive for stocks. So we'll see if that can continue. We still got 80% more of the companies in S&P 500 that still have to report. I'll be right back after this short break. Go nowhere.
The Index Investing Show with Ron DeLegge.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
All right, welcome back from the break. October thus far has been an unfriendly month for equity investors. And the bad news, I guess you could say, is that it's not yet over. On the other hand, the good news is it's almost over. And I think despite choppy price action in stocks, we still have some positive catalysts remaining. I think the first would be a pending trade deal between China and the U.S., which is on the horizon. According to reports, that is expected to happen before the end of the year. What do you think that would mean for stock prices around the globe, especially in China where they've been beaten down? I think that would be a very positive happening or occurrence, a trade deal between China and the U.S. The other thing is, as I indicated toward the tail of the previous segment, corporate third quarter earnings for S&P 500 companies have been excellent and have largely beaten analyst estimates. We have 20% of companies in the S&P 500 have already reported, got another 80% to go. If that trend can continue, and I think it will, then I think stock prices should hopefully react positively. The other thing to think about is seasons. This might be the weakest of my arguments, but I think it's an important one. Seasonally speaking, we're entering the final months of the year, which have been historically bullish for U.S. stocks by a wide margin, especially as we get to the end of the fourth quarter. So that is on the horizon, but of course we always trade prices. We don't trade calendars. Calendars are okay as a reference point, but prices are really the determining factor. Prices are the immediate reflection of what the mood is, what sentiment is towards stock prices. So, but when we put all of this together like a puzzle, these pieces, I think there are still some positive things happening in the stock market that could give us a rally for fourth quarter, even though it's started out very, very weak. 844-305-7800 is the number. Give us your first name along with your city if you'd like to join us. How has your investment portfolio been performing? Are there any investments inside your retirement account that scare you? Any stocks, ETFs, mutual funds, or things that you're concerned about? How has your investment portfolio been performing? Have you been doing better or worse than the broader market? These are things that you need to be asking yourself right now. Of course, we can help you do that on the program. We can help bring some of these things to light and help you understand the things you should be doing within your investments so that you can get ahead, make progress, and beyond that, protect your capital. Because it's not just about building an investment portfolio and growing it, but it's also about protecting your capital, protecting your money. And so I posed the question, does your retirement portfolio have an adequate cushion? Because if it doesn't, well, it will be revealed. It will be revealed in time. And many investors have made the mistake by being fully invested. Every single penny that they've got is fully invested. Well, you take a look at the investing greats. They're never fully invested. There's your lesson. What does that tell you? Because they have capital, they have money that's ready to take advantage of fire sales when they happen. And they're also able to take advantage of market chaos. They're able to buy when others are selling. You can only do that if you have a margin of safety built within your portfolio. So let's talk about that, because that's one of the fundamental differences on this program. And in general, the philosophy that I try to help you have inside your own investments is that a healthy and well-built investment portfolio absolutely has to have three components. The first component is your core, which is indexed across the 5 major asset classes. The next is the non-core portion of your portfolio, which could be tactical. You can invest in individual stocks. You can invest in call options, put options, leveraged ETFs, inverse performing ETFs. These are investments that are highly concentrated in nature, often higher risk, but they can allow you to take advantage of various market trends that may present themselves. And then the final component of a well-built and healthy investment portfolio is what we're talking about right now, is your margin of safety. The concept margin of safety was originally developed in the 1930s by Benjamin Graham and David Dodd, the founders of modern-day value investing. Now, their idea was applied to selecting individual stocks at undervalued prices. Dodd and Graham's principles about safety, though, are all equally applicable to how we manage a portfolio of investments, how we manage our retirement money. And so in the context of you, me, the individual investor, your margin of safety represents the capital or money that you absolutely cannot afford to risk to unrecoverable market losses. So you're essentially, what you're doing with your margin of safety container is you're segregating a portion of your total assets for safety. This money gets set aside from your core and your non-core portfolio to be invested in fixed accounts with principal protection, guaranteed income, and liquidity. Also very important is the timing. The timing of when you put or install your margin of safety inside your portfolio. Why do I say that? Well, because the prudent investor does not wait for a financial meltdown or stock market crash to establish a margin of safety, right? It's like buying insurance. You're not going to buy insurance when the house has been set ablaze. There's no insurance company out there that's going to insure that house if it's on fire, right? And so the same thing with your investments. The prudent time, the opportune time, the optimal time to establish that margin of safety is to do it when market conditions are relatively friendly and favorable, like now. The market prices are still favorable, and it's a good time to install a margin of safety if you have not yet done that already. And so this is the context of what it means to have a margin of safety within your investment portfolio. 844-305-7800 is the number. You're listening to the Index Investing Show. We'll talk a little bit later about what percentage of your portfolio should be earmarked for margin of safety. I know that's a question that some of you are probably asking. In terms of our sector check, what's going on in terms of industry sector performance? Top performing sectors continue to be technology and healthcare. XLK and XLV are the ETFs tracking those areas. Technology ahead by almost 11% since the start of the year. Healthcare stocks doing really good. That's the top performing sector. XLV ahead by almost 12%. Also, consumer discretionary stocks still holding up pretty strong. XLY ahead by almost 9%. And other industry sectors that are doing well. Utilities, XLU ahead by 6.2%. Utilities are a defensive sector right now, and interest rates have been trickling higher. And I think that's one of the reasons that utilities have been pretty strong. Also, in some other areas that have not been such good performers, have been basic materials. XLB down 11%. That's the worst performing sector, and a lot of struggling companies there in commodity linked sectors. And that's about it. All the other industry sectors with modest losses or flat gains on the year, and that's what's going on there. So when we come back, we're going to talk a little bit more about how to determine what percentage of your portfolio should be earmarked for safety. That and much more right here on the Index Investing Show.
The Index Investing Show with Ron DeLegge.
Are emerging markets on the move? For bold trades on emerging market stocks in either direction, trade EDC or EDZ. Directions Daily MSCI Emerging Markets Bull and Bear 3X shares. Don't miss your next big trade. Direction leveraged ETFs.
An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit us at www.directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors, such as traders and active investors. Distributor, Foreside Fund Services, LLC.
Have an investing question for Ron? Call 844-305-7800 or send your questions to @IndexShow on Twitter.
I forgot to mention the communication sector has been a good performer too. XLC ahead by almost 7% since the beginning of the year. So that area has done very, very well. 844-305-7800 is the number. If you're just joining us, you're listening to the Index Investing Show. We've been talking about ways to shore up your investment portfolio, your retirement money, to make sure that you've got an adequate cushion. Because, well, the stock market could do anything. It's been great the past 9 years, really since the financial crisis, right? It's been every single year we've had consecutive gains, back-to-back gains. But we know that this too shall end, and that at some point stock prices will go down. And we know that's happened in the past, and it'll happen in the future. And so the point is to be ready for that moment, but also to prepare, we need to take action. We need to do things. We can't just have this folksy advice or follow that folksy advice to do nothing. I see a lot of that. You know, when stock prices fall sharply, all these folksy people come out with this folksy advice saying, oh, the best course of action is to do nothing. Just sit there and do nothing. You know, because stock prices will rebound because they always have rebounded. Well, that's sort of true. We know that stock prices have rebounded, in many cases, very quickly. Within a matter of less than 2 years, stock prices have bounced back. During the past two bear markets, the financial crisis from 2008 to 2009 lasted it seemed like forever when it was happening at the time. But in retrospect, it was not a very long period of falling prices, even though the price drop was pretty sharp, right? 40% decline in the S&P 500. But 2000 to 2002, that was what, 2 years, 2.5 years approximately of falling prices. It felt, again, like it was forever as it was happening. But relatively speaking, it was not a very long, extended, drawn-out bear market, not like the 30s. The 1930s, Great Depression era, we saw a long period of just abysmal performance after the crash happened. The stock prices went up, but they mostly went down. And then, too, there have been long periods where equity prices haven't done anything. Anybody that knows market history should remember this, looking at stock prices from 1967 to about 1981 or 82. look at the chart on the Dow Jones Industrial Average for that period of time. From 1967 to about 1981, stock prices did not really do anything. They were pretty much flat that whole time frame. Now, of course, you would have collected some dividends along the way, but my point is that we can go long periods of time. It is possible for stocks to do absolutely nothing after they've, obviously have gone down or corrected. So the point here is to have a margin of safety that's adequate, that's custom to you, that fits in with your overall investment goals, and also gives you some peace of mind so that you can sleep at night and not do anything that would be counterproductive. Because when people are fully invested, when people are over leveraged with their investments, when they've got all their money concentrated or focused on one asset class like stocks, or one asset class like real estate or bonds, and then that one asset class crashes, inevitably they crash right along with it. And so what we want to do is we want to avert any type of personal financial crisis that may be triggered by a collapse in prices. And so the way to do this is to have an adequate cushion within your retirement portfolio, what we call a margin of safety. So this is what I teach in my online classes. Those of you that have not yet become students, you can go to indexshow.com and click down on my online courses. I offer 4 online courses. And in my flagship course, Build, Grow, and Protect Your Money, a step-by-step guide, this is one of the fundamental principles that I teach, is having an adequate margin of safety. So one of the things that you get in that as a student once you enroll is what I have is called a margin of safety worksheet. It's a one-page worksheet that will help you to determine exactly the right amount for you. There's a series of a couple questions that you can answer, 4 questions, that will help you to determine the precise amount of your investment portfolio, your retirement money, that should be earmarked for margin of safety. In other words, capital or money that gets set aside from the rest of your portfolio, your core and your non-core, to be reserved for safety, principal protection, liquidity, guaranteed income. That's what I mean by safety. And the types of assets we use for margin of safety, by the way, are assets that do not fluctuate in value and assets that do not fall in value. So that would mean that things like gold, things like bonds are not appropriate for your margin of safety. And that's another huge mistake a lot of investors make. They think, well, I see stock prices falling. Let me put my money in gold. Let me put my money in bonds. Well, guess what? Bonds and gold can also fall in value, and they have fallen in value. Bonds as a group, total U.S. bond market, ticker symbol BND, the ETF that tracks it, is down 2.5% this year. Yeah, I know that yields have gone up, but bonds are squirrely. Bonds can go down in value. One of the problems with bonds in this kind of climate is that when interest rates go up, bond prices fall. So any gain that you get from higher yields has been offset by lower values. And so it's hard to get ahead with that type of investment. But the point is that margin of safety has no chance of loss, 0 chance, 0 volatility. So you deliberately are doing this to not only protect yourself, but then you're also, think about it, if the 3 parts of a well-built and healthy portfolio are a core, non-core, and margin of safety, each one of those parts should be doing something completely different than the other part, so that there's no overlap, so that there's no dilution in the benefit. And so this is one of the other advantages of having a margin of safety. So the types of assets that should go into a margin of safety or that qualify for margin of safety are things with FDIC insurance, like bank deposit accounts, CDs, savings accounts. You can also use insurance contracts, guaranteed annuities, principal protection notes, that also qualifies as a type of asset you could use for your margin of safety container. 844-305-7800 is the number. This is the Index Investing Show. We're here. How has your portfolio done so far this month of October? It's been a rocky month. It's also been a great month for bearish investors that have been what I might call selectively bearish, right? Selectively bearish on areas that have been weak. And those particular areas that I think about that really jump out have been long-term U.S. Treasuries, horrible place to be a bull, and then Chinese stocks, another horrible place to be a bull at this moment. If you've been a bear and you've been using some of those inverse performing ETFs that we've talked about on this show many times, inside your non-core portfolio, that is the right context. And man, has it been a great trade. Ticker symbol CHAD, which goes 100% daily opposite of China A shares, ahead by just over 27% since the start of the year. That's been a great trade. I think it's still got more upside. TMV, which aims for triple daily opposite performance to long-term U.S. Treasuries, ahead by almost 30%. So 2 great trades for bears that probably have some legs. I'm Ron DeLegge. I'll be right back. Stay with us.
The Index Investing Show with Ron DeLegge.
Stop investing blindly. Listen to the Index Investing Show with Ron DeLegge every week on iTunes and IndexShow.com. Learn how to grow and protect your money.
Okay, some things that on our Twitter feed at Index Show. Trump's tax cut is not paying for itself, at least not yet. My comment on that is this: tax cuts will pay for themselves with future tax hikes. That's how this is going to play out. You can write it in stone. Tax cuts will pay for themselves with future tax hikes. They will not pay themselves by economic growth or GDP growth or any of that other cute, nonsensical view that these economists tried to invent. Also on the Twitter feed, Chow Yun Fat. I know that sounds like a cartoon character, but it's an actual person. Has a $714 million fortune, yet this individual lives just on $100 a month. That's according to an article that I've linked to. My comment on that is tightwads will enjoy this cute but exaggerated story. And that's what it is. It's an exaggerated story that the media has extracted to make it seem like, wow, these people, wow, they only live on $100 a month. They've got a fortune that's worth almost $1 billion. Wow, if they can do it, you can do it too. What a bunch of hogwash. Also on the Twitter feed, look at this. Senator Majority Leader Mitch McConnell on the $780 billion national deficit. That's a 17% increase and $21 trillion in debt. He says that it's driven by 3 of the most popular entitlement programs, Medicare, Medicaid, and Social Security. Yeah, no kidding. No kidding, Mitch. Everybody knows that. Did you just figure this out? It's something that we've talked about on this program rather consistently. It's one of the other reasons why we love tax advantage, tax-free accounts like Roth IRA, Roth 401k, Roth conversions. If you missed it, a couple of weeks on this program, a couple of weeks ago, we had the author of the book called The Power of Zero, David McKnight, on the show. You can go to indexshow.com, listen to that archive. But we talked about why taxes are going higher. So you can check out that podcast, Beware of Higher Taxes in Retirement. Also on our feed for podcast, Diffusing Single Stock Risk. We talked about that on last week's program. Also, why the Dow Jones Industrials is flawed. That was something that we discussed recently also. So that's all on our podcast archive. You can go to indexshow.com, listen there. One other thing on the Twitter feed that I enjoyed reading and that I think you would enjoy is a 93-year-old woman. This is a question that was posed by MarketWatch. Should a 93-year-old woman have 20-year corporate bonds in her portfolio? So we're talking about bonds that expire or mature in 20 years. Now, she's 93 years old. So my answer to that question is, if her life expectancy is age 123, and she's making a strategic bet on lower interest rates between now and then, it's okay for a 93-year-old woman to have 20-year corporate bonds in her portfolio. Absolutely. But none of this is the actual case. So absolutely not. She should not own 20-year corporate bonds in her portfolio if she's 93. One other thing on the Twitter feed, since I'm having so much fun with this, is a quick post to the CNN Fear and Greed Index, which I think is a good barometer of understanding the psychology of the stock market. Where is the stock market in terms of fear, in terms of greed? Is it greedy? Is it fearful? Well, right now, we're at extremely fearful levels. Right now, we're at 13. Just a month ago, we were at 71, which is very greedy. Remember, 100 is the highest in terms of greed. 0 represents extreme fear. 100, extreme greed. We're at 13 in terms of extreme fear. That's pretty high. And we've said it before on the show, is that a fearless stock market is a dangerous place to invest, right? Well, the opposite could be true. We could say that a fearful stock market is a much safer place to invest, because the opposite is true. And so that's something to think about. Stock prices, remember, are not a reflection of valuations, but rather of our psychotic manias. The psychotic manias of humans, because these are the folks, these are the individuals, these are the people that make up the stock market, right? It's not just institutions, it's humans. It's us as investors, traders. 844-305-7800 is the number. You're listening to the Index Investing Show. ETF Guide Premium, the November issue is out. A lot of good things in that. We told you about the global equity map. There's also a market meter, which gives you key levels for the S&P 500 that you absolutely need to watch in terms of safety. If we fall below certain key levels, that it could trigger even more downside. At the same time, there are some positive things that I discussed earlier, but those key levels are covered in ETF Guide Premium, the November issue. Also, a highlight of some key trades for the non-core portfolio that we've put on and that we've executed. We put on a trade back in late September on the Direction Daily CSI 300 China A Shares ETF, ticker symbol CHAD, which we discussed earlier. It aims for 100% daily opposite performance to Chinese stocks. That's been a great performer thus far in 2018. And if Chinese stocks continue to slide, it will continue to rise in value. We banged out almost a 6% gain in that particular trade. And we're looking for another entry. If we get a nice 1 or 2 day rally in Chinese stocks, that could be a great opportunity to re-enter that trade. Also, home builders are crashing. They have been one of the worst non-S&P 500 sectors this year, and it's been another great trade on the bearish side. Back in April, this was for ETF Guide Premium members. We told you about a bearish trade on ticker symbol ITB, which is the iShares U.S. Home Construction ETF, and we played that by buying some put options. And we sold those put options on October 11th for a 26% time-stamped trade and gain. So that was another excellent trade that was available to ETF Guide Premium members. And we've got another new trade on home builders, so you'll have to check that out. That's in the November issue. We've also got the income trade for November, which we discussed earlier. And on next week's show, I want to tell you about some new quarterly reports for ETF investors that have just been released. So stay tuned for that. And then also on next week's show, we're going to talk about some of the industry sector performance and how to play this market with some of those sector ETFs from the Select Sector Spiders. Dan Dolan will be joining our program on next week's show, so stay tuned for that. 844-305-7800 is the number. This is the Index Investing Show. We're here every week at this same hour, and you can follow us 24/7 at Index Show, and let us know how you're doing. Now, I wanted to mention briefly before we close today's program of how to determine how much of your portfolio should be earmarked for safety, because that's a question that sometimes comes up. And I deliberately built the Margin of Safety worksheet to help you do that. That's available to my online students. Just go to indexshow.com and enroll in my classes. But generally speaking, there's a couple of things that you could do to determine what is the right amount for you. One simple metric is just to take your age. Take your age and earmark that for safety. Now, that I would say would be the most conservative yardstick or guideline. And if it's too conservative for you, well, then just simply tweak it. Say, I want less of my money earmarked for safety. That means you're going to have a slightly higher risk portfolio. But nevertheless, if you can absorb that risk, then you'll find the right amount. Well, that does it for another episode of the Index Investing Show. Thank you for joining us. We'll be here again next week. And until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.